Welcome to The Explainer. Today, we are digging into a fascinating story. It's about a crypto project that had everything going for it, a mission to revolutionize banking, big-name partners, and then its token price just completely fell off a cliff. This is the story of Rails. And this, right here, is the core puzzle we're trying to solve. How does a project with such a perfect, buttoned-up, institutional story end up with a price chart that looks like an absolute disaster? It's a serious contradiction. Okay, so let's start at the beginning. We have to understand the grand vision, the story that Rails was selling to the world. And let me tell you, their pitch was slick. Right off the bat, you can see this wasn't for your average retail crypto degen. They were speaking the language of boardrooms, not Discord channels. We're talking infrastructure, stability, compliance, all the words that big money loves to hear. And they didn't just talk the talk, they walked the walk. They were on stage at Davos, for crying out loud. They partnered with Web3 giant Animoca Brands. They were doing everything right to build this institutional halo, to show the market they were the real deal. So what were they actually building to back up this huge pitch? Well, at its core, it all came down to one key piece of tech designed to make banks feel safe and sound dipping their toes into the blockchain world. The secret sauce here is something called the privacy node. Think of it like a private, walled garden blockchain for each bank. It lets them manage their digital assets securely, away from the chaos of public chains, but still gives them a bridge to connect when they want to. And this analogy they used was just brilliant. They weren't saying, hey, we're here to replace you. They were saying, we're here to give you a blockchain-powered upgrade to the systems you already know and trust. It was a message tailor-made for easy adoption. All right, but in crypto, it all comes down to the token, right? The story is great, but what about the economics? Let's look at the engine they built to supposedly make the RLS token more and more valuable over time. First things first, a fixed supply, 10 billion tokens, that's it. No more can ever be printed, ever. So right from the get-go, they established a baseline of scarcity. Now, they designed this thing they called the flywheel. The idea is actually pretty clever. The more banks use the network, the more fees are generated. Those fees are then used to buy RLS tokens from the open market. Then, and this is the key part, half of those tokens are burned, just destroyed forever. More usage means less supply. It's a classic recipe for a deflationary asset. So let's just step back for a second. We've got a killer story, A-list partners, and what looks like some really smart tokenomics. I mean, on paper, this thing looks bulletproof. But this is crypto, and the market always has the final say. Because when the RLS token finally launched and met the real world, the reaction was not what anyone was hoping for. It was fast, it was vicious, and it left everyone asking this one simple question. And this chart says it all, doesn't it? Instead of that beautiful, steady climb that the narrative promised, you get this, a complete nosedive, a total disconnect between the story they were telling and the price the market was willing to pay. Let's put a hard number on that pain. At its worst, the token was down over 94% from its all-time high. A drop like that, that's not a correction. That's a full-blown market verdict. Yeah, a drop that severe isn't just volatility. Analysts started calling it a credibility event, which is really just a polite way of saying the market completely stopped believing the story. So we've got to perform an autopsy here and figure out what happened. This quote from an analyst just nails it. You can't blame this on a bad market because the project launched when institutions were getting more interested in crypto, not less. The market didn't just shrug its shoulders at Rails. It actively, aggressively said, no thank you. So what was the murder weapon here? Well, a lot of people point to this classic crypto landmine, the low-float, high-valuation launch. It's a structure that lets a project claim a massive paper valuation, but it creates this incredibly dangerous imbalance where there's just not enough supply to meet any real selling pressure. And with Rails, this was a textbook case. You had this huge 10 billion token total supply, but only about 1.5 billion were actually out there for people to trade at the start. The other 85% locked up, just waiting in the wings. So put yourself in a trader's shoes. You know that this massive amount of supply is coming. The unlock schedule is public. It's like a ticking time bomb. So every time the price goes up a little bit, you're not thinking, this is the future. You're thinking, I better sell right now before the next wave of tokens hits the market and crashes the price. And this really gets to the heart of the matter. The token was priced as if banks were already using it full scale. But the reality? The project was still in the pilot phase. It was all promises of things happening next quarter. So the market was basically being asked to pay a Ferrari price for an engine that was still being assembled on the factory floor. So, where does all this leave us today? Well, it's pretty wild. You have two completely opposite ways of looking at Rails. Is the story dead and buried, or is it just getting started? This table just lays it out perfectly. It really captures the split personality of the project now. The bulls, the believers, they say, look, forget the messy launch. They're still building, they're working with central banks, this thing is deeply undervalued. But the bears, they just point to that ugly chart and say, the tokenomics were flawed from the start. The project has lost all its credibility. It's over. And that brings us to this final killer question, which just perfectly frames the entire dilemma. It forces you to decide. Is that chart just the messy beginning of the future of finance, or is it the finished drawing of a trap that worked exactly as it was designed?